Let's learn about duration in fixed income investing. Duration measures how long it takes for an investor to be repaid a bond's price by the bond's total cash flows. It can also measure the sensitivity of a bond's price to changes in interest rates. The bond's duration is not the same as its term or time to maturity. Duration is a measure of how much the price of a bond or debt instrument changes when interest rates change. The higher the duration, the more a bond's price will drop as interest rates rise. There are two types of duration, Macaulay duration and modified duration. Macaulay duration is the weighted average time until all the bond's cash flows are paid. Modified duration measures the expected change in a bond's price to a 1% change in interest rates. Macaulay duration finds the present value of a bond's future coupon payments and maturity value. The greater the duration, the greater the interest rate risk or reward for bond prices. It can be calculated manually by finding the weighted average time until the cash flows are paid. For example, a 3-year bond with a face value of $100 that pays a 10% coupon semi-annually and has a yield to maturity of 6% will have a Macaulay duration of 2.684 years. The longer the duration, the more sensitive the bond will be to changes in interest rates. Modified duration helps investors understand how much a bond's price will rise or fall if the yield to maturity rises or falls by 1%. This is important to know if an investor is concerned about short-term interest rate changes. It is calculated using a specific formula. Duration is used to quantify the potential impact of credit risk and interest rate risk on a bond's price. It is important for investors to be aware of these risks and how they will affect a bond's expected yield to maturity. Long-duration and short-duration strategies refer to an investor's focus on high or low-duration value bonds. Long-duration strategies work well when interest rates are falling, while short-duration strategies are employed when investors think interest rates will rise or to reduce risk. Duration measures a bond price's sensitivity to changes in interest rates. Bonds with longer time to maturity will have a larger duration than those with a short-term maturity. As a bond's duration rises, its interest rate risk also rises. Duration is used by traders to manage the riskiness of their portfolio and make adjustments to it. Here are 5 key takeaways. 1. Duration measures a bond's or fixed income portfolio's price sensitivity to interest rate changes. 2. When interest rates rise, the higher a bond's duration, the more its price will fall. 3. Macaulay duration estimates how many years it will take for an investor to be repaid the bond's price by its total cash flows. 4. Modified duration measures the price change in a bond given a 1% change in interest rates. 5. A fixed income portfolio's duration is computed as the weighted average of individual bond durations held in the portfolio. Hope this would help. Thanks for watching.